Morning, Market Chameleons. Happy Thursday. Dimitri Pargamonic. How are you doing this morning, buddy?
Good morning, Will. How are you?
Good. So what are we going to look at this morning? Actually, we should start with the disclaimer, I guess, huh?
Yeah, let's get that out of the way first. So before we get started, everyone keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen real quick. And I think what we'll do today is usually we just go over the pre-market movers, but I might, unless there are questions, I might just skip it today and start something new and go over maybe one specific topic just to get, more time into it. And after we did the interactive brokers webinar, there were some questions on implied volatility that I think were interesting. And yesterday I talked to a customer, also had some questions about implied volatility and option premiums. So I wanted to kind of cover that part of it and look at option premiums, but from a different perspective than implied volatility, because some people, they look at implied volatility and they hear, well, there's an implied volatility rank, implied volatility is high, implied volatility is low. But, what does that actually mean? Because if you're looking at implied volatility, the model, basically the Black-Scholes model, is assuming that you're actually trading volatility. You're not trading an option just buying and selling, but you're trading volatility, you're trading your delta, you're trading your gamma. And I'm going to show option premiums from a different perspective, which I think is just going to be a little bit clearer what we're talking about. And let's just start with SPY. I'm going to kind of explain to you before I go to the option premiums and show you this tool. If we're looking at an options chain, in SPY, and we see all these different strikes, right? We have 7 days to go, so we have different expirations. We have different strikes in options, and we have calls, we have puts, and then we got prices for all these options. And the problem becomes that when you're looking at all of this, it's just numbers right now. It's raw numbers, and it's very difficult to analyze. And what I mean by that is just you have an option here with the price, and when you're a trader, you want to see, well, is this a good price, a bad price? Is it undervalued, overvalued? And not unlike stock, options are different instruments. They decay. Eventually, they're going to expire. So you kind of have to see what is a value at this moment in time, right? That's what you're trying to do, is say at this moment in time is $2.90, the one I'm hovering over. Is that high? Is it low? And by how much? So in the comparison, some people might look at a stock, a price, and they might compare it to a moving average, how far away it is from like a 20-day moving average, or you might compare it to multiple, how a PE ratio or a price to sales ratio, and say the price to sales ratio is 5. Historically, it's been 6, so it might be undervalued, or you could compare it to other like assets. But in options, you kind of want to do the same thing, unless you know where the stock is going. Then you know if the option is underpriced or overpriced. And usually, because to solve that problem, to help solve that problem, there are option pricing models, and there are different ways to look at option prices. But the Black-Scholes binomial option pricing model, they'll convert this option to an implied volatility. And the volatility really is just telling you, well, based on this option price, it's converting it, then it assumes a standard deviation move over a year, right? So that's what it's doing. It's converting into a standard deviation, implied standard deviation move over a year's period. And this way kind of standardizes it so you could kind of compare option versus option on a relative basis. Now, I think that becomes confusing unless you're trading if you know how to trade volatility. then it's good. You know, it's the best model we have. It's not perfect, but it's kind of like the best model that you could apply universally. But it does become confusing if you're not trading the realized volatility, which I think many people do not. Some people do, but I think most people do not. And some people don't have the ability to do that because you're going to have to short stock sometimes, you know, trades the deltas back and forth. So let's take a look at a different way how to assess where these option premiums, how high or low they are, maybe give them a quantitative view. Okay, so I'm going to go here to this tool under volatility and look at risk premiums. And what this will do is actually convert the option into a premium, a risk premium. So because there are a lot of different options, a lot of different strikes, different expirations, we kind of have to do a benchmark. And the first thing is here are the different benchmarks you could select from. So the first benchmark is, well, what is the maturity, right? Because you could have 5 days to maturity, 10 days, 20 days, as many as you want. So a standard way to benchmark right now, industry standards, 30 days. That's like really where the VIX is, or in the industry, usually, if you look at the first benchmark, it'll be 30-day constant maturity. And so that's what we're going to leave it at, a time frame, an option with 30 days to maturity. And if you drop it down, you could select 60, 90, 120. But let's stick with, for this example, we're looking at an option with 30 days to maturity. So in other words, it's going to look at options in the options chain. And because there isn't an option every day with 30 days to go, because they'd have to list a brand new option every day, there's a weighted average formula that looks at the two expirations that straddle 30 days and gives it a weighted average. So every day it gives it a new weighting based on the days to expiration. And if you wanted to see that formula, it's the same formula that's used in the VIX. You could go there, you know, look at the VIX, and you'll see it's a weighted average between two expirations that straddle 30 days, and every day changes. Then, well, if you're looking at 30 days, then you have different strikes, right? That's the next thing you need to benchmark. And you could have at the money, you could have out of the money calls, out of the money puts, how far out of the money, right? You could go 5% out of the money, 10%, 20%. So there are different strikes to benchmark as well. You know, there's no just one right one, there's just different ones. Now, the VIX does it a little bit differently. They just give a weighted average to all the strikes to kind of, you know, just get a volatility for an overall month. We're doing it where we're like, okay, we're more interested to see based on where the option is relative to the spot price, okay? Because an out of the money option will trade at a different volatility, and sometimes the skews are moving around. So we want to kind of separate those benchmarks and see, you know, what is an at the money option, what is an out of the money put, an out of the money call, right? So this is the first thing, is we're going to set up which benchmark we're looking at, and then we're going to look at the premium. So the default one is 30 days to maturity and an at the money put, right? Now, instead of looking at the implied volatility, this is what we're going to do. We're going to convert that option into risk premium. And by premium, I mean, if you bought insurance, if you had a house that was like, say, $100,000, okay, and you wanted to insure it for 1 year, right? If you wanted to insure it for 1 year, and the insurance companies told you it would cost you $2,000 in premium, well, that's 2% of the price of your house. You're paying 2% premium relative to the price of your house, right? So you wouldn't pay $150,000 to insure a $100,000 house. That would be silly, right? So how much are you paying in premium relative to the price of the house, what you're insuring? So that's how we're looking at this. if we're insuring SPY for the next 30 days, and we're buying at the money put, so we're basically saying we're buying protection to the downside, well, how much is that going to cost us for 30 days to insure? And this is a historical premium. This is converting it day to day, a historical premium, how much it is. So up here, we see yesterday it spiked up, right? Because now there's more volatility. It spiked up, option premiums went up. So this little orange bar here, this is the 52-week average. So you could see in the last year how the premium for the 30-day insurance, 30-day put moved around. We see here in March, it started declining as the market's been increasing. So the market rises, more certainty. Usually risk premiums go down. On the downside, though, when the market's dropping, risk premiums usually go up. So we see here yesterday, popped above that 52-week average. Right now, to insure a put 30 days, to insure your position SPY for 30 days, costs you 2.5% premium versus 52-week average 2.3%. So let me know if you have questions there, but it's kind of the same idea as implied volatility, but I'm actually converting it to like how most people, I think, can quantify premium. Okay, so that's for 30 days. Of course, we could also change that to 60 days, 90 days. Well, how much would it cost us to, for example, insure ourselves for 90 days at the money put? So I'm going to reload that. So you can see here, 90 days did tick up, but not quite to the 52-week average. But we see it kind of had the same path from March. We were up here near the 52-week average line in the beginning of March. Market started climbing. Implied volatilities were decreasing, declining. Then we had that little pop in the last couple of days as the market was selling off. So we're right now to look at 90 days out for an option, 90 days out to insure that position for 90 days costs us 4.1% to insure that position. Of course, anybody selling it acts like the insurance company. They sell the premium, and if the stock just sits there, they'll collect that premium. The stock goes up. If it's unhedged, they'll collect that premium. But that's how the market right now is pricing in that put. Okay, so we went over a couple things right now. Benchmarking the risk premium based on time frame, and then benchmarking it based on which strikes you're doing. So let me now go back to the 30-day constant maturity. And I'm going to do this now to look at the 5% out of the money put. All right, let's do 2% out of the money put. I'm going to do 2% out of the money put. I'm going to reload the chart. And now this is what this is saying. So what does this mean? 30 days, 2% out of the money put. If you imagine it like this, if you insured your car, right, and had no deductible, you would have one risk premium, right? They'll give you a policy and they'll say like, okay, you have a $20,000 car to insure it for a year. It's $2,000 per year. So what does that equal to? 10% of the 10% premium, right? 10% of the value of your car. That's what it will cost to insure. But if you want to lower that insurance, maybe you don't want to pay that much, right? You don't want to pay that much in premium. What they're going to tell you is, well, what about if you had a deductible? Well, what does that mean? A deductible means that for the first $1,000 in damages to the car, you're responsible for it. After that, then your insurance kicks in. But if you do that, then maybe your premium will be $1,000. So what they're saying is, well, you're responsible for the initial hit, let's say $1,000, right? You cover that, and in return, we're going to lower your insurance premium. So it went from 2,000 maybe to $1,000. So now to insure your car, whatever is 5% out of the money, you're only paying like 5% premium instead of 10%, right? So this is the same idea. If we go further out, at 2% out of the money, that means that the first 2%, if the stock falls from here, the first 2%, we're eating that, right? We're responsible. We're not insuring that part of the downside. So that part is our responsibility. After 2%, that's when the insurance kicks in. That's the put. How much does that put cost? Well, we see over here, it just climbed yesterday. So that it's above the 52-week average, but right now it costs us 1.9% in premium versus 52-week average of 1.6%. Okay, so that's the comparison of what it costs you to insure from right at the money to what if I go 2% out of the money, and you could keep going this way, 5% out of the money, we have it all the way down to 20%. So 5% of the money, I'm going to reload it. So here, it'll cost us 1.2% in risk premium. But remember, the first 5%, that's our responsibility. So if you own that stock, it falls down 5%. You lost 5% on the stock. You didn't get any. And if that's all it went down, you're going to lose that premium insurance as well.
So you'll be down 7%.
Huh?
So you'd be down 7%.
You'd be done, yeah, or in this case, exactly 6% here, because that's a different way of looking at risk premiums. But again, instead of implied volatility, we're looking at risk premiums relative to what it usually costs us historically. So now we're kind of, quantifying it maybe in ways that we're familiar with, right, in the real world, dealing in real world insurance policies.
Hey, D, we did have a question which is kind of digging a little deeper into Mr. Ram is asking, is there a term structure display either virtually or on the table format anywhere on this site?
Yeah, so there's a couple of different ways to look at the term structure. Let's take a look. Now we could compare it here, right? So a term structure would be, let me come back to this risk premium, but let me see if I could show what a term structure looks like. So I'm here on implied volatility, so people understand what a term structure is. And let me go down to here first. Let's do a month ago. So this is what a term structure is. And what this is saying is that the implied volatility in the 30-day, right now, this is a month ago. Okay, so I'm looking at a month ago, was 13 for the 30-day constant maturity. For the 60-day constant maturity was 14.2, 90 days 15, 120 days, the implied volatility was 15.9. So you could see this term structure, what it's saying is as you're going out to the longer dated options, the implied volatility is increasing. Now, that's what a regular term structure looks like when you're not in the midst of some crisis or sell-off. The reasoning is that if everything is okay right now, the implied volatility comes in because there's more certainty and we know more news, the news for coming up in the next week or 2 weeks, we are more familiar with than what may happen 90 days from now or 120 days from now, because as you go out further in time, there's more uncertainty, right? We kind of know what the Fed is telling us they're going to be doing with interest rates right now. We know kind of what the inflation rates, and we know when the next numbers are coming out. But as you go further and further in time, there's more and more uncertainty. So usually this is what the term structure looks like. It's sloping up, okay? We could compare it to what it looks like today. So this is what it looks like today. It reversed. So what is the deal with that? When you're in the midst of something going on, right, like a sell-off in the market, inflation fears, what's happening is that all of a sudden there's a lot of uncertainty in the present, right? And when there's a lot of uncertainty in the present, people want to buy insurance right now to cover their positions immediately. So you'll see the implied volatility actually starting to climb in the very short-term options for immediate protection. And then the expectations is, well, if the implied volatility is very high right now and everything, and you could see this green line, it's way above the yellow line, the entire term structure. You see the entire line is higher. Well, the idea behind it is if everything went up, eventually the things will cool down wherever the stocks get repriced. Either they're going to get repriced much lower, or uncertainty will go away. Whatever happens, eventually the volatility is not sustainable at very high levels. It comes back down to more normal levels, or what we've seen historically. Okay, because a stock price could keep going up and up and up, but volatility cannot go up forever, right? You cannot go up to infinity and stay at infinity. It's not sustainable. So even when implied volatility is spiking very high, the term structure will kind of start looking like this, with anticipation eventually things will calm down. But under normal circumstances, when you see certainty, right, and markets are calm and volatility is low, you'll see a term structure like this, where because there's more uncertainty going out into the future, it's going to slope higher, right? So when you think of the VIX, anybody trade the VIX? So the VIX,
There are some people out there who trade the VIX.
right? So think of the VIX as this way: you're buying. Pretend these two points straddle 30 days. Usually the VIX, you're buying this month and selling this month. So you're buying a higher month, selling a lower month, usually, right? And that's why the VIX has this negative decay over time until things reverse like it did today. So what you're doing is you're renting out protection, volatility. And if it remains like this, right, you're buying it at a higher, selling it at a lower level, you're always decaying. Okay.
Yeah, actually, Chuck was talking about UVXY. I know that's not the VIX, but I know that's another volatility product.
Yeah, because they have on the VIX, I think they have leveraged products, right? So they have other products that are leveraged. I don't know, inverse, double, triple, inverse, double, triple, but those are then it's like adding leverage to leverage, right? You could keep doing that, but I don't know what the UVXY is in specific, but some of them have leverage products. So let's come back. If we understand this, if there are no questions here, I'm going to come back to the risk premiums.
Just so how do we had like 6 chameleons say they trade the VIX. So
they do trade the VIX. So they might be familiar with the right. What do you call it? The contango? Where you're always rolling, right? Because the way they rebalance it is you always have to buy the further, sell the nearer term. So let me just take a look really quickly. If we took a long view of the VIX, so VIX is really like almost a good product if you need immediate protection, right? So you'll see these pops, right? Because you need to insure yourself like right away. You have a position, but in the long term, it's costly, right? Let's see over a 5-year period. So this is the chart. So you could see, it's costly. Even a 6-month chart, you're paying for insurance. It's not free. I'm going to come back here to the risk premiums. So one way is to look at a line, right? So this is a 30-day at the money put. We already talked about this. We're comparing it itself to historical. Another way is looking at a skew relative to each other, right? So we could look at the 30-day at the money put, and let's compare that to the 30-day 2% out of the money put. So this is looking at what it costs if we bought the 30-day at the money and sold the 2% out of the money, right? Did them against each other. So you could see here, right? You could see here, this is the average. So usually, what is it? Like a 6.62 premium, right? Right now we're a little bit below that. We're almost right there at the average. So this is if we bought one premium and sold a different premium, that would be the skew, right? Where is it right now? Right now we're at the average. So you could see here as it was falling, the skew was getting cheaper, and then it came back up to the average. So that's like a vertical, that's looking at a vertical skew within the same expiration. What if we wanted to compare a 30-day out of the money put versus, at the money put versus a 90-day at the money. So this is looking at more like a term structure. We're seeing like, well, how much, money would I receive if I bought 30 days and sold 90 days out? Because I'm selling the longer term, I should receive some premium. I should receive money. So you could see here, this was almost telecasting something's up, right? Because you could see this, the longer term started costing more and more right here around, where am I at? February, March, we're over here and just kept climbing. All right. So what it's saying is that the 90-day insurance was increasing relative to the 30-day. Does that make sense to everybody? And this is where it is now. So on a 52-week average, it's almost you would receive for doing that time spread $1.98% credit versus today 1.61.
Hey, D, we are getting a question from Mike, one of the active chameleons on the chat, and he's asking, is there a way to filter for stocks with skews in term structure, i.e. stocks that have IV higher for closer expirations than longer ones?
So, I mean, we don't have a screener for that, but this is why I wanted to convert this to premium, because when people think about IV, they automatically assume that an IV of 100 in month one, and you see an IV of 80 in month two, means automatically, well, you should be selling month one and month two. And what I'm saying is that's not necessarily the case. That's why we're converting it to premium, because if you're doing that, you're going to fall into a trap, because you're not looking at the relative premiums. And when those vols come in, if you're buying month one, and I'm sorry, you're selling month one at 100 vol and buying month two at 80 vol, and if those vols come into 40, if you do that spread, you will get destroyed because you have different Vegas going out further out. So keep that in mind. Just because you sold 100 vol, and you got 10 days to go, and then you bought something at 80 vol that has like 50 days to go, and those vols come in on both expirations to 40, your position will get destroyed. You're going to lose a lot of money, because they're different Vegas. It's not the same thing, right? You're not doing it in the same month on the same strike, so it's not an ARB. And that's why I'm trying to show to you in terms of premiums.
Yeah, I mean, Jake does say if you want to filter, you can filter by volatility. Take one of the vol levels at 100 plus, and generally they taper
Yeah.
off into the future. But you're right. When you're looking at I mean, that's a spread, right? You have to be super careful.
Got to be super careful if you don't know what you're doing. Yeah, because if that's what you're doing, if that's what you're doing is just trying to look at implied volatility and saying, I'm going to sell the higher one in 1 month, buy the lower one. Well, what's your expectation where they're going to go? Because you have completely different vega risks. And I'll show you, well, we're at 9:30, but maybe I'll draw a graph to kind of demonstrate that.
Yeah, well, this is a
tomorrow.
good conversation with where the market and everything that's going on right now. So let's continue it tomorrow. Great
Yeah.
job, Dima.
All right. Well, thanks everyone for joining. Hope to see you guys tomorrow. Stay safe out there. Have a good trading day.
Excellent. There are a bunch of new chameleons who've popped up. So anyone who wants a link to the Discord, I have put it in the chat to email me, williammcbride@gmail. I will get that Discord link. That Discord was not created by Dimitri or I. That was created by Jake, aka the doctor, who's in the chat. People really enjoy that discussion after this discussion, so it's always good to have availability to that. Again, great job, D. Thanks so much, chameleons. Have a great trading day, everybody.
Thanks, everyone. Bye.
Trade in peace.